If you're starting a business and the bank told you no, this video is for you. Traditional banks rarely fund true startups. If you don't have 2 years in business, strong revenue history, high credit scores, or collateral, your approval odds drop quickly. But here's the good news. Bank loans are not your only option. There are alternative financing options specifically designed for startups. The key is understanding how they work and choosing the right one for your stage of growth. First, let's understand why banks say no. Banks lend based on history. They want to see proven revenue, consistent cash flow, and low risk. Startups are new, unproven, and still building systems. That doesn't make them bad businesses. It just makes them higher risk in the eyes of traditional lenders. Alternative financing looks at opportunity and potential instead of just history. One of the most accessible funding options for startups is business credit cards. These are often based heavily on your personal credit score rather than your business history. They can be useful for purchasing equipment, covering software subscriptions, marketing expenses, or short-term operating costs. If used strategically, especially with introductory 0% interest offers, they can provide breathing room while you build revenue. However, you must manage utilization carefully. Maxing out cards can damage your credit and limit future funding options. If your startup is already generating some revenue, revenue-based financing may be an option. With this type of funding, you receive capital in exchange for a percentage of your future sales. Instead of fixed monthly payments, payments adjust based on how much your business earns. This works well for e-commerce businesses, service providers, agencies, and online brands with consistent sales activity. The benefit is flexibility and fast approval. The downside is that the overall cost can be higher than traditional loans. You're paying for speed and accessibility. Another strong option for startups is microloans. These are smaller loans often provided by nonprofit organizations, community lenders, or local development institutions. They typically range from a few $1,000s up to around $50,000. Microloans are especially helpful for early-stage businesses that need manageable amounts of capital. Many programs also include mentorship and business training, which can be extremely valuable for new entrepreneurs. For startups with high growth potential, angel investors may be an option. Angel investors use their own capital to invest in early-stage businesses in exchange for equity. This is common in technology startups and scalable business models. The major advantage is that there are no monthly payments. The trade-off is ownership. You are giving up a portion of your company, so this decision should align with your long-term vision. Crowdfunding has also become a popular path. This involves raising smaller amounts of money from a larger group of people, often online. Some models allow you to pre-sell products as rewards, while others involve offering equity in your company. Crowdfunding works best when you have a strong audience or compelling story. Success often depends more on marketing and visibility than on the financial structure itself. If your business requires equipment financing can be one of the easiest approvals. In this case, the equipment itself acts as collateral. Because the lender has something tangible securing the loan, risk is lower, which increases your chances of approval. This is common in construction, transportation, restaurants, and medical practices. Some entrepreneurs turn to friends and family. While this can be helpful, it must be handled professionally. Always put agreements in writing, clearly define repayment terms, and treat it like a formal investment. Mixing business and personal relationships without structure can create long-term conflict. No matter which funding path you choose, preparation is critical. Before applying for financing, make sure you have your business entity formed, an EIN, a business bank account, basic financial projections, and a clear plan for how the funds will be used. Many startups make the mistake of chasing money before building structure. Funding follows preparation. Lenders and investors want to see organization and clarity. Alternative finance is not a last resort. In many cases, it's the smartest strategy for early-stage businesses. The key is choosing capital that supports your growth rather than creating pressure your business can't handle. Not all money is good money. The right funding should create leverage, opportunity, and stability, not stress. If you found this helpful, make sure to like and subscribe. And if you want more breakdowns on startup funding strategies, drop a comment below. Your business doesn't need permission to grow, it needs the right strategy and the right capital.